Yeah, I think it's been a very trying start to 2019. We all know that in 2016 we had a very bad drought in this country and the maize harvest fell to the lowest level in nearly 100 years. In 2017 it rebounded quite sharply. We had a harvest of over 17 million tonnes. Last year we were down to about 13.2 million tonnes. And in context, this country uses about 10.8 million tonnes a year. So the reason why 2018 and 19 is quite important is we have seen concerns regarding the weather in this country. It's been much drier in the northern parts of this country for planting, which has raised concerns regarding yield and the ultimate size of the yellow and white maize harvest this year. Now, why is that important? Because maize goes into a lot of things. It's how you grow a chicken, it goes into mealie meal, it goes into a number of food products that we consume on a daily basis. From its low point in mid-2017, yellow maize is now up nearly 50%. So in a tough economy, it is very unlikely that food companies are able to pass on the full cost of that increasing input cost to the distressed consumer.
But yellow is mainly for feedstock, right?
Correct. So yellow is mainly into the animal feed sector, and white goes into the human chain.
Right.
So this country tends to grow equal amounts of both, and then we export any surplus.
Sure.
Now, because of the delayed planting season this year, because it's been very dry in the northern parts of this country, the underlying price of maize and Safex has soared. You know, as of this morning, we're at about 2,700 rand.
Safex is the South African
Futures Exchange. So as of this morning, yellow maize is about 2,700 rand a tonne, and white maize is around 2,900 rand a tonne. Now, as a context, at its low point in the middle of 2017, which led food companies to report excellent earnings in the last results period, you could have bought white and yellow maize for around 1,800 rand a tonne.
Sure.
So we're up around 1,000 rand a tonne. Now, again, in this economy, it's difficult to pass that costs on, which is why for the last few months I've been informing my clients to actually lighten their load in certain food stocks, because there's going to be margin problems and earnings difficulties in the first half of 2019 and into the latter half of 2019.
Just mention some of those stocks for the benefit of our viewers.
Well, I'll give an example. It's Astral Foods, which has nearly fallen by 50%. Pioneer Foods, which is probably off 40%. Quantum Foods, which is down about 20%. And of course, Rainbow, which is, or RCL Foods, which is now a diverse company, but still has a large chicken element. They hit a new all-time low yesterday in the 13 rands. So all food stocks are cognizant of rising input costs, a distressed consumer, and we are watching the maize price very closely because it is so relevant in the input supply chain to this country, and the share prices have been hit hard.
And yet you are optimistic for 2019 for some of the food stocks. Explain why.
Absolutely. It's all to do with timing. The market always looks forward. As it stands right now, we are waiting for the first crop report to come out from a crop estimate committee at the end of January. That'll give an indication as to how big or how small the crop will be. The early estimate is 12 million tonnes, which is below last year's 13.2. We still have enough carryover to keep us going. But if a crop is less than 12 million tonnes, Safex will remain higher for longer, which will have an impact to food companies. If the crop estimate committee comes up with a fairly favourable number, there could be a relief rally in the food counters. As it stands right now, it's too early to tell because we need Mother Nature to start raining quite heavily in February, and no one can predict the weather in this country. But as it stands right now, most of the food companies, Astral, Pioneer, Quantum and Rainbow, have been hit and are reflecting weaker earnings in 2019. But as the year starts moving forward, the market will start to look to harvest 2020. And I'm saying we are probably within 5 or 10% in share price terms of looking at buying those stocks to look forward into next year. So anyone with a penchant for value picking and looking for bottom fishing should be putting those stocks on their radar screen probably for the next 3 months and looking at them.
Before I come in with the next question, I just wanted to take the conversation slightly back and talk a little bit about the impact of the prices that you're talking about on inflation.
Well, as we know, if you look at the underlying inflation in this country, it runs at around 6%. However, that's overall inflation. You have to look at inflation in the context of certain consumer categories and certain consumers. You and I both know that the poorer end of this market, who have a much lower wage, who are either unemployed, on social grant, or who live on basic minimum wage, spend a greater proportion of their income on food and transport. So when we see rising prices, for example, on bread, on basic vegetables or on chicken or on any basic, like mealie meal, it affects them more.
Yeah.
And as such, it's difficult to put up price increases, and you see volume contraction. So we aren't the real consumer, us who go to Woolworths.
Yeah.
So it has a much bigger impact on the lower LSM consumers, and they are currently in a very difficult place because of the economy.
Absolutely. So let's go to the bottom and fish, as you suggested. Where would you be going? What would you be looking at?
I think on a 6 to 12 months view, I have two interesting scenarios. One, Pioneer Foods is now at about 81 Rand. It's the country's second largest food company.
Yes.
It is essentially in bread, pasta, mealie meal, and it has a growing grocery division. It has now been hit very, very hard. The cheapest way into Pioneer Foods is via Zeda Investments, which is part of the PSG stable.
Right.
It owns about 56 million shares in Pioneer Foods, which is about 26% of the company. Zeda is currently trading at about a 23% discount.
Right.
So if Pioneer Foods has a share price recovery in the next 12 months, perhaps after the election, when Cyril Ramaphosa starts getting the economy going as we hope, and a little bit of a feel-good factor.
Did you just say that?
A little bit of a feel-good factor. Perhaps Pioneer will start to recover, and if Pioneer recovers, given that it has such a large weighting inside Zeda Investments, I think Zeda could be a very interesting play. As it stands right now, we've got many AGMs coming up in February with Pioneer Foods, Astral Foods, the crop report. So I'd sit and wait, but I think before the end of March, value investors and bottom fishers would do very well picking up some food stocks and putting them in their basket for 2019, late 2019 recovery and a better 2020.
Absolutely. I was going to make the point that in addition to looking at the small cap sector and making sure that you understand the agricultural sectors, Anthony also does look at the political issues. He sees who's going to be winning that election come March or whenever that's going to be. Who would you avoid?
In terms of shares?
Yes.
I think right now there are certain companies that are battling. For example, Libstar Holdings. They listed on the stock market at £12.50 in May 2018. Within months of that listing, they had a profit warning on the 17th of August. The share price went from £12.50 down to a low of under £6. It halved.
Sure.
It's now picking itself back up. We're now trading at around £7. But it predominantly targets the higher end consumer via Woolworths, which is this major client, and it has ready meals and a lot of value added products. Now, for a company which has missed its initial IPO numbers, the market is very unforgiving. It's also instigated a very large share buyback program, which is propping the share price up. But more importantly, it's a December year-end company.
Sure.
There'll be a trading update coming out probably in the next few weeks, and the results probably in late February, early March. If those numbers aren't up to scratch, the relief rally we have seen in Libstar could give way, and it could start to sink again. So I think I'd be going more towards the basic food companies who have a much broader platform of products, and I'll probably be avoiding the higher value stocks.
Sure.
We've had problems with Tiger Brands with listeriosis. We've now got Libstar, which has missed its numbers. And I'll be looking at more of the primary food companies which will recover on the back of more water in this country and recovery in the agricultural chain.
Two quick questions before I let you go. There's been the outbreak of foot and mouth, which we know will impact possibly exports of meat. Swaziland is already concerned. What would you avoid in terms of that?
Well, again, there aren't many listed food companies in that sector. You know that the biggest beef company in this country is called Karan Beef, which is currently in a deal with the PIC and private equity. There aren't any directly listed food companies. However, many of the agricultural food co-ops, which are listed on secondary markets, have interests in animal slaughtering and animal husbandry.
Okay.
So perhaps they would be impacted, but there are no direct companies on the JSE that would be impacted.
Final